Join me a little bit on a journey here because it just dawned on me. In the early days of this pandemic, you spent about $3 billion in the span of 3 weeks. Is that correct?
Well, we prefer to say invested. But yes.
Well, you invested $3 billion. I mean, that number in itself is wild. Why is it wild? Because KKR was one of the biggest firms that we knew that spent money at that time. They spent only about 2.5 in that time frame, and you are less than less than 5% of the size of KKR. So you clearly capitalized on the early opportunity at this pandemic. But I want to ask you now, obviously the opportunity set moving into pandemic 2.0 is much different than what we saw in March. How is the investing landscape changing for you?
Yeah, well, we have both equity and debt. And what you were referring to was on the debt side when you had the massive dislocation in late March and early April. What we've seen in prior downturns, and you can tell by my lack of hair that I've been through a few. I always say I've lived through 88, 98, 08, and now 2020. The debt markets dislocate first, and then the equity markets follow. So we see a very target-rich environment, at least in the verticals in which we invest over the next 2 years, and it will take a while to play out. But there's some recurring themes, and one of those themes is the lack of debt availability, similar to what we saw in the 08, 09 downturn. So we think the equity markets have, when I say the equity markets, I'm talking about real estate specifically and investing. We think a good 12 to 24 months of outsized opportunity set.
Well, you were also early in this pandemic. In the summer, when everybody saw the light at the end of the tunnel, you said that this would last a little longer. So how much pain do you see in the second part of this pandemic, and how does that change the way you invest?
Well, we've obviously got a very accommodative Fed, which does not hurt real estate at all. We focus on alternative verticals, particularly medical office, that have outperformed both in good times and bad. And this is, we would put this pandemic obviously in the latter category. I still am, reluctant to make any predictions about the timing and how this pandemic will play out. We tend to think that it'll take a good 6 to 12 months from this point to really get the healthcare crisis behind us. The economic ramifications are much more far flung. But as I said, we expect the Fed to remain accommodative. We think that there will be fantastic opportunities on the real estate side, particularly in the asset classes in which we invest.
Speaking of an accommodative Fed, you have also talked about this moral hazard that comes with it, right? What distortions are you seeing happening in the market around you that may be cause for concern?
Well, yes, there's always a moral hazard dynamic. We saw that play out on the debt side. So bad actors to some extent get rewarded. And that's just, that's the way that it works. You've got to obviously protect the majority of people. And so selfishly, we wish that the Fed had been a little slower in its reaction. That's on the debt side. On the equity side, meaning, obviously acquisitions on the real estate side, I don't see really, other than potentially industrial, really much of a moral hazard. I see it far more in the public markets and with the SPAC craze. And, while history may not repeat itself, it certainly rhymes. So we see a lot of, in my view, unfounded enthusiasm and momentum, but I don't really see that playing out on the real estate side in the same way as I see it playing out on the SPAC side or maybe in the public markets.